Ladies and gentlemen, we're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here at the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session, the first in a series on position adjustments, we'll take a look at some scenarios for when the market shifts or when your opinion on the underlying changes, and we'll go through it all in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of the retail market to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you can submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Rolling with the Market, Position Adjustments, Part 1. Joe?
Nick, thanks very much and great to be with you. And everybody, thanks for joining us today. Managing option positions and rolling with the markets. I mean, I'm really excited about today's presentation because, you know, our markets are so dynamic and, you know, things oftentimes don't go the way we expect. So, you know, what do we do? How do we roll? How do we adjust? Is a question that many of us who are out on the road get frequently. And so I hope that, you know, when we're finished our presentation tonight, you'll have maybe a couple new ideas as to how to adjust. Also like to give a shout out to Darren Tate from our Investor Services Group for stepping up and offering his presentation a few weeks back. For those of you who may have missed it, you can see that on demand, you know, if you're interested. So Nick, we'll get started with today's presentation, and you know, as certainly people in the option space know, we do have the ODD, the Options Disclaimer Document, which is the characteristics and risks of standardized options, which states that options aren't for everybody, but it's a great pamphlet to define the risks and benefits, you know, in the listed options market. This is you know, actually one of my favorite slides along with the next one. These are the folks who fund us and allow us to come out and have webinars, podcasts, live events. So it's our 12 option exchanges along with the members of the OCC. And here's the story of the history of our business. You know, back in April of 1973, we started with 16 different listings on the CBOE, and of course we're now up to close to 4,000 listings. Going from that first day, I think we were 928 contracts. We're averaging a little over 4 million a day now, and it's a great growth story, and it's one that can, you know, the listed options market continues to expand. So our presentation today, you know, we'll talk about, you know, some basic starting points. We'll then start with initial position, and then we're going to talk about 5 different adjustments. We're going to talk about selling calls to recover our initial investment. We'll talk about rolling up to a higher strike, rolling out for more time, rolling up and out, and then we'll look at, you know, actually after having a big profit in our position, spreading off as opposed to just taking that profit and seeing how that can improve our returns as well. So, you know, some things as we get started, common sense approach to investing, having some knowledge, obviously, doing your homework on the underlying. I mean, as those of us in the option space know, most option investments and positions start with an opinion of the underlying. And, the great thing there is there are only three choices: neutral, bullish, or bearish. And with that, you can pick different option strategies to basically parlay that underlying opinion. Of course, discipline is very important, and for every investor out there, there's probably a different recipe as to how to trade options. Discipline, though, really being a key aspect of being successful. And at the same time, this whole idea of flexibility, having a sense for knowing when to adjust, and that's really an important factor too. More common sense, as we said, selecting that underlying stock and then having a forecast, critically important, and then we'll kind of go and maybe match a particular strategy and contract to that forecast. And of course, before we do any of this, we want to make sure that we've got approval to do straight option contracts, and then getting up into different levels where we get into the spreads, make sure that's approved with your broker. Of course, after we establish positions, it's important to just have a sense for, are we going to stop out if things go against us and close out? Are we going to roll down? Different things like that. But really that goes back to the whole idea of discipline, having an investment recipe that works for you. Risk versus reward, always critically important. Actually, spent many years on a trading floor down in Philadelphia, and as I tell a lot of people in the live events, I frankly expected to make money, trading on a day-to-day basis. It was always about risk reward, and being wrong and not losing a lot of money meant that I was doing things right. My decisions based on risk reward were definitely slanted to my side. So, just do your homework, have a good sense for, that whole idea of, real common sense, risk versus reward potential, and then apply your option strategies and adjustments around that. Certainly the whole idea of getting out and cutting losses can be awful important. The whole idea of liquidating a position, can be a really difficult choice to make, but oftentimes it's the best because it frees your mind, it clears your head and allows you to move on to the next strategy rather than just suffering day after day with a position that's gone wrong. And then the point today really is about making adjustments, and whether that's rolling up, rolling out, spreading, these are all different choices that we as option investors have a chance to do. One more thing before we get into some of the roll potentials, the whole idea of short options. Now, we want to be aware of the whole possibility of pin risk, and whenever we're short calls or puts, we have that potential for pin risk. As we get close to expiration, if those options are in the money, we can certainly expect assignment where we're going to have to deliver on that obligation, either to sell stock or buy stock, depending on whether we're short a call or a put. And those in the monies especially, we can really expect assignment. For the out the money options, there's less certainty, so really this gets down to you managing your position. If assignment is acceptable, you really don't have to do anything. If it's not, then you clearly must manage that position and maybe either, flat out just close it out or, potentially roll to another strike. So here we go. Let's get started with our different scenarios for rolling with the markets. Our initial position, we've got XYZ, which we're bullish on. Stock currently trading at $50. Our initial forecast is a very bullish forecast. We're looking for XYZ to go from 50 to 60 in a couple months. So that's bullish by anybody's account. So what we decide to do is initiate a June 50 call position. We buy 10 June 50s for $3. So we're going to commit a $3,000 investment to this position. And here's how it looks. The good old hockey stick P&L chart. You can see the horizontal line that goes out to the left there. We've committed $3,000, so that's our maximum loss. Our break even, for those of you just getting started maybe, you take the strike price plus the debit paid, which in this case is $3. So it's 50 plus the 3 takes us to our break-even point at expiration is $53. If the stock closes above 53 at expiration, we'll have made money. Below 53, we'll have lost some money. If the stock went somewhere between 50 and 53, those calls would be in the money and have value, so we would be able to recoup some of the $3,000 investment. But you can see in the chart, the leverage that can be associated with options. If that stock were to go to 55 at expiration, in our initial position are those June 50 calls, which is the right to buy stock at 50. The stock's 55. That right is going to be worth $5 at expiration. Paid 3, that means we make 2 or $2,000. And you can see in the chart how the numbers just increase significantly as the stock goes up. One of the nice things, to the downside is we know our loss is limited. The maximum loss is the debit we pay for these options, which is the $3,000. So, as we said, we're very bullish on XYZ. We think it's heading up dramatically over the next 60 days. So let's take a look at 5 different scenarios. Number 1, stock up, but the target not met. Our forecast, we're still bullish, but we're cautious. So what do we say? 60 days to expiration. We've got about 3 weeks left. So we want to make an adjustment. We don't want to just leave, our $3,000 investment on the table. So we decide to sell enough contracts to recoup our $3,000. So again, initial investment was $3,000. We're long 10 of the June 50s at $3. And we've let 5 weeks go by. The stock has had a nice little run to 56, but we've become more cautious. So we're an aggressive investor, or at least one who's managing the position, and we decide to take the action to recoup our profits. So as it turns out, we could sell the June 50 calls at $6. The stock's at 56, 3 weeks left. I mean, obviously, we get $6. That's the intrinsic value. There'd probably be a little more time premium. But to keep things simple, we could turn around and, sell 5 of these June 50 calls at $6. That would recoup our initial investment. And so, essentially, the remaining calls, as it says on the slide, they're free. Stock continues to go up. We'll make plenty more money. If the stock goes down, we're still going to, make some money. It's just a question of how much, unless the stock were to, fall all the way below 50, and then our trade would just be a break even, less commissions. So again, there's the hockey stick, but what we've changed by selling 5 of our initial June 50s is we've changed the trajectory and the loss potential for this potential roll. So, that's one approach. Lots of common sense. Used to do this on the floor all the time. I would always think about, net debit or credit on a particular spread. How many dollars do I have on the table? And, then depending on changing opinions, I would sell out maybe, just like in our example here, something close to the net investment. So I would, still have maybe some upside or some downside potential depending on whether they were calls or puts, but I wouldn't have the same economic risk. So that's scenario number 1. Scenario number 2, again, stock up. Stocks had a heck of a run, so we've been right in our forecast, but we haven't quite met the target. We started with 6 weeks, with 8 weeks to expiration. So, stocks had a big run in a couple weeks because we still have 6 weeks to expiration. So our forecast actually has changed again, and we're even more bullish on the underlying because there's additional positive news. So we've raised our $60 target, but we're remaining the same. We want to keep the same time frame. So we've raised our target. We've got 6 weeks left. The action we really decide to take is to roll up to a higher strike. Well, why do we want to roll up to a higher strike, you may ask? Well, rolling up, it depends. We're going to add leverage. We may take some chips off the table. Let's go through a couple different scenarios. So the objective is to increase the target price at no additional cost. That's it. We get potentially get a higher break-even point. We're definitely going to increase the leverage on our profits to the upside, and depending on what strike and how many options we trade, we may reduce our downside. So let's look at the numbers. Again, the original position is 10 June 50 calls for 3. We decide to sell the 10, and the stock now is 58 with 6 weeks left. So, let's look at the price of that call first. So we've got $8 of intrinsic value. We've got it $8 in the money. So with six weeks left, we've got 40 cents of additional time value left because there's certainly some value in the put if we're thinking about that whole put-call parity relationship. So we get to sell 10 of the June 50 calls at 8.40, taking in $8,400. And because our forecast, again, is more bullish, we're not just going to take that profit and put it in the bank. The whole idea here is to roll up. We're going to turn around and buy 15 of the June 55 calls. And those calls are currently priced at 510, so we get to buy 5 more calls, granted at a higher strike, but we get to do that at a price that's less than the 8,400 that we just took in. So we're actually reducing. So we get to do that spread for a net credit. We buy 5 more calls. We take $750 off the table. So our original debit was the $3,000. We take $750 off the table. Our net debit now is $2,250, and we've got additional calls to the upside if our forecast turns out to be correct. So that's one roll-up scenario. Let's look at another. If we roll to the June 60 calls, again, we've got 6 weeks left in this example. There's a heck of a lot of time. More good news, stocks already run 8 points in 2 weeks. So, stocks don't go up forever, but here's the scenario. So, again, we could sell the June 50 calls with the stock at 58, take in $8,400 by selling them. If we wanted to roll even higher into these June 60s, we could buy twice the number of 60s as we could 55. So we could buy 30 of those calls for $280, which would basically be a break-even trade, selling the 10 June 50s, buying 30 of the June 60s at $280 for even money. So our net investment on the trade would still be that $3,000. So, let's take a look at, there's our original trade. Again, the 10 June 50s for $3. Here's the 10 June 55 call, rolling the 10 June 50s into the 15 June 55s. We have a higher break-even point, but a lot more leverage to the upside. And after we go through our scenarios, we're going to go back into the math as to how you figure out the break-even point at 56.50. And then if we take a look at the June 60s, look at that leverage. It's just off the chart. That line is darn near straight up. So scenario 2, which is scenario 2A and 2B, rolling the June 50s into June 55s, or turning and rolling the June, and that June 55, don't forget, we actually took money off the table. So we did that for net credit, reducing our initial $3,000 outlay to $2,250. And in the June 60s, we spent the whole $8,400 and still have $3,000 invested in that trade. Obviously, if we decided to buy fewer than 30 of the June 60 calls, if we wanted to take some money off the table that way, we just could buy less than the 30 calls. So that's scenario number 2. Scenario number 3, stock up again. Target not met, but again, this stock is hot. We've gone from 50 to 57 in about 5 weeks. Still have 3 weeks to expiration. The all-important forecast, the target price remains the same, but we've used up 5 weeks. We got 3 weeks left. We're getting nervous about time, so we want to roll out in time. We want to roll out in time. And let's see how we do that and how that potentially impacts our debit or credit. So again, extending time frame at no cost. So that's important. We're not going to put anything additional, anything in addition to the 3,000 we've already put up. So from a common sense standpoint, if we're going out in time, same strike, and we're not willing to put up any more capital or spend any more money for that time, then clearly we're going to have to reduce the number of calls that we're long. That's going to be the net impact. So let's take a look. We roll out these July 50 calls. Again, stock 57, 3 weeks to go, $7 of intrinsic value. In our example here, we've got 20 cents of time value, so we can sell those 10 for $7.20, taking in $7,200. We decide to buy 8 of the July 50 calls, and their price is $7.75 or 7 3/4. So, we could have bought more. We decided to take some chips off the table. So, we get to do this particular spread for $1,000 credit. And as option users and traders, this is one of the big decisions you have when you are, from your initial position, but then again, when you're rolling. Do I want to commit more capital to a position? Do I want to take some chips off the table or take some money off out of the position and put it in the bank? And that's just position management. That's actually to me part of the fun of trading options. Making adjustments, making these decisions. More often than not, obviously, you want these things to go your way, but it's part of the challenge of the financial markets. Do I do it for a debit? Do I do it for a credit? When do I roll? Do I roll up? Do I roll out? To me, again, that's really part of the fun of this. So in our example, again, we're going to take 1/3 of our money off the table. Our net investment now is going to be $2,000. And here's how it looked. There's the original 10 lot, the 10 long 50 calls for $3. Since we took $1,000 off the table, and we reduced the number of calls. Even though we bought more time, our break-even point actually went down. A little less upside because we've got 8 versus 10 long calls, but we've lowered our break-even too and given us now, 7 weeks to expiration rather than the 3. So, that's that particular scenario. Scenario 4. Stock up, target met. Okay, about 30 days left to expiration. So again, this is one hot stock. We started with 60 days. In 30 days, the stock's going from 50 to 60. And once again, we've got a forecast here where we're more bullish over the next 60 days. So we decide again to raise our $60 price target and extend the time frame. So we're not just rolling up, we're rolling up and out in this particular scenario. So let's take a look. And again, of course, the objective is just to give us more time. We want to do this at no cost. So oftentimes when you're making your decision, you got to go into the marketplace and see where, the different options are trading, and then you just got to, do the simple math. I got $3,000 on the line to start out. How can I do this thing for even, for a credit, if you decide to commit more money? It's not hard to do, but obviously depending on the premium levels and things like that and the various options, that's going to impact how many options you can buy and sell, and whether you're doing these rolls for debits or credits. Rolling up and out. So again, we started with 10 June 50 calls for 3. We're going to roll up to the July 55 calls. So again, the target for the stock originally was $60. We've met that target, but rather than just taking our profit, which is a home run profit, buy the call for 3, sell it for 10.15, that would be a home run. But that all important forecast says that we are more bullish, so we're going to continue to work this. And we turn around and sell 10 of the June 50 calls. We get to take in the $10,150 by selling them for 10.15. We decide to roll up to the July 55 calls, and we get to buy 15 of them. So we know the stock's $60. So they're trading for $6.50 because we've rolled out in time. So there's $5 of intrinsic value, $1.50 of time value, and we get to roll into 15 of these July 55s, and we get to do that for $9,750. So the net of that spread is a $400 credit to us, which again is going to reduce our net investment from $3,000 down to $2,600. So that's rolling out to the July 55 calls. Another choice, of course, could be rolling to the July 60s, and you could roll the 65s if you wanted to as well. But here we'll take a look at rolling up to these, rolling out and up to these July 60s. Again, we'll sell the 10 June 50s. We'll sell them at 10.15, taking the $10,150. And again, we did not want to commit more money to this trade, so the July 60s, with the stock at 60, they're going to be at the money calls. They're trading for $3.50. We get to buy 29 of those calls to do this trade for even money and keep our net investment at $3,000. So again, we started with a break-even point of 53. We roll to the 55s out to July, from June out to the July 55s, 15 of them, and we have a new break-even point there, which again, we're going to go through some math very shortly to show you how we get these break-even points. And July 60, again, depending on how bullish, how much time premium you're willing to take on, here are a couple different roll choices for you. Last scenario we'll review, stock up. Once again, we're an investor who had a very, very good forecast. That stock ran from 50 to 60, target met, happened in a month. I wish I was that good. So we've got these June 50 calls trading at $10.15. Forecast, we've had this big run. Well, we think the stock's, going to pause. Not really going to pull back necessarily, but pause. So we're neutral on the underlying over the next 30 days. And the action we decide to take is to spread off the 10 June 50 calls that we paid $3 for and create a bull call spread. All right, bull call spread. Buy the lower strike, sell the higher strike, whether it's at the money or out of the money. Typically is how these bull call spreads get worked out. So we decide we're going to sell 10 of the June calls right at the strike to try to benefit from the premium. Again, we think the stock may just hang out in this $60 range. We've still got a month to go, so these June 60s are certainly still going to have some value. So let's take a look. We sell the 10 June 5th, or excuse me, we still own the 10 June 50s. They're valued at $10.20. We paid $3. So potentially if we just turn around and sold them, of course that's a home run trade. You take in $7,200 profit. I think by anybody's estimation that's a home run. But again, managing positions, everybody's got a different way. Some folks feel more strongly about some underlyings than others. If you happen to feel very secure and kind of in a groove about the way a particular underlying or underlyings are moving, this could be a very sound approach, and we'll go through the numbers to see how that $7,200 profit can increase dramatically by rolling into this type of spread. So we know we're long the 10 June 50s. We initially paid $3 for them. The June 60 calls with 30 days at expiration are going for $2.40. So in essence, we get to do this $10 call spread for the ridiculous price of 60 cents. So, with the stock trading at 60, that spread's got all kinds of intrinsic value. We know our break-even point from the original trade was 53. The debit for the bull call spread was 60 cents. So we've taken our break-even from 53 all the way down to 50.60. With the stock trading at 60 and us being long the 50-60 call spread, we don't want that stock going anywhere, too far south, or we'll have left, a decent amount of money on the table. But, let's look at it a little more closely. Actually, let me just back up one sec there for the, how would we potentially maximize our profits? I did it again. Sorry about that. Instead of a potentially $7,200 profit. Let's go through this, okay? At expiration, if we're right on our forecast and that blue dotted line has the stock at $60, we had sold those calls for $2.40. We paid, again, 60-cent debit for that call spread. If we were fortunate enough to have that stock expire at 60, what would the value of that $10 bull call spread be? Well, if the stock were right at 60, the 50 calls would be worth 10, and the 60s, would go out at 0. So we'd have a $10 call spread, which we paid 60 cents for. We'd have made, $9,400 on that particular spread. So that's where, taking a profit, you can never argue with taking a profit, but if you, have a strong opinion, oftentimes there are better ways to do things. And if, in fact, our forecasts have turned out to be accurate here, you can see we could have put a significant additional amount of profit in our account by selling the 60 call and rolling into that bull call spread, as opposed to just taking the $7,200, which again that's a great trade by all accounts, but there are different ways to optimize. Remember now, if the stock goes from 60 before expiration down to 55, and our forecast for that stock being neutral over the 30-day period turned out to be wrong, what would have happened? Well, at 55, that spread would have been worth 5 at expiration, less the debit we paid. Our profits would have been down to $4,400. But that's assuming, the stock pulled back 10% from 60 to 55, or close to 10%. So these are the things that we keep in mind all the time as option users. Risk reward, when do I take my profits? When do I roll? As I said, to me, this is a great deal of the challenge and the fun part of using options and trying to build that account. I told you we would get into calculating the P&L and the break-even points after a roll. So there is a little bit of math here. As Nick said, these presentations will be available for at least the next 90 days if you have to go back and double check the math. It's really pretty simple, but it takes a little while, to get used to what you have to do. And basically the recipe is this. You take the net investment after our roll. So we started with a $3,000 investment. We're going to take the net investment after the roll. We divide that number, whatever it is. If we did it for even, it's $3,000. We can go through a couple of the examples. In each case, it was either the $3,000 or less. So we take the investment, the net investment after the roll. We divide that by the number of new contracts in the new position. So it's the net investment divided by the number of contracts in the new position, and then again divide that amount by the $100 contract multiplier. And we can go through a couple examples, and then we add that, whatever that number is, we add that number to the new strike, and that's how we calculate the P&Ls. So that's the recipe. It's taking after the roll the new net investment divided by the number of new contracts in the position divided by 100, and whatever that number is, we add it to the strike. So, we had rolls where we stayed in the 50 strike, went to the 55 or 60 strike. You add that number to the strike, and that gives you your break even. And that's why, we had some of those crazy numbers, which, I can go back to, we'll go through a couple more slides here, and maybe I can go back to a few of them. We can go through it. But, that first roll where, the target was raised and we rolled up, this is the scenario. You got the long June 50 calls. We rolled up to the June 55s, the 15 of them, or the 30 June 60s. So, in that scenario, you can see the leverage we gain as the stock continues to go up. And that's why, whether it's myself, whether it's one of the colleagues from Investor Services or another one of our guest presenters, it's always so important to be managing your positions. And I think that's, that's one of the consistent messages that you get from all of us. If we look at the P&L calculation, in this, I think, was scenario 2, because the first scenario was where we took, the 5 calls off the table, and we had then no money on the table for our net investment. In the second scenario, we rolled up from 10 of the 50s to 15 of the 55s. I think we took in $750. So our net investment at that point was $2,250. So that break-even point, we went from, we took $2,250, we divide that by the number of new contracts, the 15 new contracts, divided by the multiplier of 100, that equals 150, or 1.5, and it's the 55 strike, so it was the 55 plus the $1.50 gets us to a break-even of $56.50. And I know that's what the slide was showing. With the 60 roll, similar thing. We rolled to the 60s. We bought 30 of them. The net debit was break even, so we still had $30,000 on the table. It was $3,000 divided by the now 30 contracts divided by 100. That equals 1. The strike price is 60. So our new break even there is 61, and so on. Here's the roll out scenario where you can see we took the original 10 long June 50s, rolled them out to 8 of the June 50 calls, bought some more time and, felt more comfortable with that position as well. You can see, we took some money off the table because our maximum downside there went from $3,000 to $2,000. We did that roll for $1,000 net credit, which you can see that represented bottom line at $50. With the stock at 50, the original position would have been down 3,000 versus 2,000 with the roll. The next one, the roll up and out, to the July 55s, 15 of them. And again, we took in a few $100 there, so our break even to the downside, was reduced by $400 to $2,600. When we bought the July 60s, our roll was for even money, so that's why our break even is still our maximum loss potential is 3,000 to the downside. But you can see how these numbers do increase to the upside. So we gain, obviously the additional leverage with the additional calls in the position. And then, the spread off, again, very similar situation. You can see where our maximum downside losses are versus our upside profits. And, that's what, we always want to be mindful of as we're making these various adjustments. So, that gives you an idea of the various tables, some of the upside leverage. Let me just once again repeat that calculation for break even. After the roll, you take that net investment and you divide it by the number of new contracts in the position. You divide that number by the $100 multiplier, the contract multiplier, and that's going to give you a number, and you're going to take that number and add it to whatever the new strike you've rolled to. So that's the recipe for figuring out those different P&Ls that you saw on the charts as we were going through the various roll examples. Just a couple more slides before we go to questions, Nick. I think much of this is really common sense. Monitoring positions, of course, is very important. A couple things that monitoring does, it obviously, allows you to keep track of your profits and losses, and, that's first and foremost. But as implied volatility levels change, and as you've maybe rolled into more at-the-money calls versus fewer in-the-money calls, you've got more time premium, and that's where your risk is. Again, knowing the risk-reward components is always important. When you roll up or out and you decide to take on more options and increase your leverage, but at the same time increase your time premium, it's important to have a sense for what the implied volatility levels are, because depending on, let's go back to what is implied volatility. Only listed options have implied volatility, and that is the market's expectation for how much the underlying is expected to move going forward. So if the premiums are high, the expectation, and it doesn't suggest direction, it just suggests movement. If the premiums are high, the expectation is that stock's going to, or index or ETF is going to be, moving quite a bit. If the premiums are low or the implied volatility are low, the opposite is true. So it's a good idea to, use the implied volatility charts at optionseducation.org. Great tools. Go in, take a look, especially if you're going to roll. I mean, it starts with the forecast of the underlying, but the next step is really to try to not necessarily have an opinion. It's great if you do, but at a minimum, be informed of the implied volatility levels for the underlying you're trading. And that really is just, if you're just getting started, that's going to be beyond you, but for those of you who are in the space, it's just, it's really a common sense approach to monitoring. Of course, different considerations for rolling. Time is always important. Some friends and colleagues in the business often say, if you've got a forecast and you think it's going to happen in, X amount of time, well, by the following month. So you give yourself even a little more time. So, what strike, what month is always a couple challenging questions that oftentimes don't have black and white answers. We talked quite a bit tonight about spreads. Do be aware of, the different spread deltas. So those deep in the money calls are going to have a whole lot more delta than those at the money calls. In our last example, we rolled into a bull call spread. That bull call spread, as you get close to expiration, has a delta close to 100, which means, as the stock goes up, that spread should go up $1, although it can't, go any higher than the difference between the strike prices. So if the stock went from 60 or 59 to 65, the value of that 50-60 call spread can never exceed 10, which I think we know. More importantly, from the risk side, as we mentioned, if we were wrong about that stock just hanging out in the 60 level and it retraced back to wherever, 58, 56, 55, if we're close to expiration, those 60s are going to run out of delta. All the delta in that spread is going to be in the 50 calls. So it's just important to be very mindful of the delta in your spreads because that helps you to quantify your risk. And then, just in terms of whether you roll, we talked a lot tonight. We never rolled for an additional debit. We started with $3,000 and never exceeded that. But whether we roll for a debit, for neutral, or for credit is a very important consideration and one that, is going to just, as I say, be very important as you try to maximize your various returns. So I think, Nick, that's pretty much it. I hope for our regular listeners or those who are new, if you don't know what that 888 options number is, our colleagues, some of who you're beginning to hear on some of the webinar presentations, they're there 5 days a week to answer any options-related question you may have. And then, of course, our website at optionseducation.org, you can find all kinds of wonderful tools, information, podcasts, webcasts, you name it. So I think with that, Nick, maybe we can go to some Q&A. I hope there is some.
Absolutely, Joe. We got a couple good questions. One thing I would like to note for our listeners today is that today's presentation is going to be available through On24 access via the same link that you used to attend today's session. Go ahead and click that link. It should be live, I believe, this evening or definitely by tomorrow, and you can replay that. As Joe said, check your math, look at some of the different positions, and refamiliarize yourself with the content. So, Joe, one of the number one things that we got people asking about today is what happens when the price drops? Is that going to be a session that we're going to do in part 2, part 3 of our position adjustment sessions?
Absolutely, Nick. And I thought from a consistency standpoint, it might be good for us to just, go in one direction as we started this series. Our next, let's see, I think it is the 8th of July, will be actually rolling covered calls will be the core there. There will be some downside. We'll have another one on the 19th of August, and I think we're going to focus on the put side there. So that'll be rolling down with puts. And I think following that, Nick, there will be a presentation where we'll have a stock going the other way, and we'll mix it up a little bit.
Great, thanks, Joe. And for everyone, you can always check the optionseducation.org website. We've got a number of webinars there that you can sign up for all the way out up to the end of July right now. And as Joe said, actually, I believe through the beginning of August, we've got things that you can sign up for. So go ahead and check those out. But we will be talking about what happens when the target price drops during those future sessions. Joe, another question we got a few questions about was about out-of-the-money calls. Is it possible to be assigned on an out-of-the-money short option at expiration?
Okay, let's talk about that. And let's say, why would we be assigned an out of the money? By its name, out of the money, and if we're talking expiration, it means it has no value. So we shouldn't be assigned an option that has no value. At expiration, options are worth intrinsic value. If there is no intrinsic value, there's no reason for somebody to exercise the option and therefore assign you. But I will say this, Nick, and it doesn't happen often, but occasionally investors or professionals foul things up and they exercise the wrong option. It really happens very infrequently. But it could happen. What happens far more frequently, and this is where position management comes in, if we've got, either we're very deep in the money and there's a fair amount of time left to expiration, but because we're so deep in the money, there's little time value. Or if we're in the money and very close to expiration and there's little time value, you can get assigned sooner than you may think. That happens far more frequently, but for the most part, the obligation of, selling the stock or buying the stock, depending on whether we're short a call or a put, you can, manage that most of the time because, frankly, people usually don't exercise when there's still time premium because, by exercising, they're taking delivery of the stock, either long stock or short stock. But if they went to the market and sold that option that still has time premium, they'd collect more money. So that's why, and that's because, if there's timed expiration and there's additional premium, you've got the intrinsic value plus the time value. So the net owner of those contracts will take in more money by actually going to the market and closing out his position rather than exercising. When he exercises, he forfeits any of that time premium. So, it happens, Nick, but I hope that explanation helps a little bit people to understand, why and how.
Joe, you mentioned assignment at the beginning part of that last answer, and a couple people asked about reselling the option. If you do find yourself assigned, can you resell that same option, or the underlying rather, to avoid assignment?
No. Okay, once you're assigned, let's go back to the very basics. Okay, buyers have rights, sellers have obligations. So if you are assigned, you have the obligation as a call seller to deliver that short stock. If you were to turn around and sell additional calls, you'd have doubled your position. So the answer is no. You would, by selling another set of calls, you would have duped or doubled your position.
Another question we saw a number of times, Joe, was about some real life examples. What is a typical scenario in which it might be advantageous to roll the position?
Well, we went through, honestly, I guess there were 5 different scenarios. That's real life. Now, we did happen to, run all the scenarios, with stock going to the upside today. And we are definitely going to change that going forward. We'll run sideways, down, the whole thing. We'll do it with puts. We'll do it with different strategies. But the roles that we went through today, they're real life. The only thing that was pretty aggressive about the examples is that, in a couple of them, the stock absolutely, we were very bullish on the stock. The stock was 50 and it ran, up, 10, 20% over the course of 4 weeks. That's pretty aggressive, but that, I would hope people think that's real life. More importantly, I think, is, as stocks move, the choices that we went through today are, there are only so many different choices out there. And I think we hit on 5 really excellent examples. I hope people feel that way. This is real life. And I think over the course of the series, Nick, we'll have just additional real life examples for our listeners.
Great. Thanks, Joe. One other question we had. If you're at expiration and you have a call, but the stock is between your spreads, what happens? Do you get assigned on the in-the-money call? But then what happens to the out-of-the-money?
Okay. I like the question because it speaks to the confusion of rights and obligations. We talked about, if it's in between, the bull call spread. Let's go back to our example. We're long the 50 calls. We're short the 60 calls. Stock originally was, the stock, at the end of our example was at $60. Let's say the stock's at 55 and we're at expiration. We're right at expiration. So we've got the 50 call, which is the right to buy stock at 50 with the stock 55 at expiration. That's worth $5. In our original example, we paid $3. But the 60 call, which we sold for, I guess, $2.40, is worth nothing. It's $5 out of the money. So the question is, as far as assignment, and that was all that was mentioned was the assignment side. Well, we can only be assigned on our short side. And again, when we sell an option, we have an obligation, but we get paid for that obligation. But what do we give up? We give up control. Assignment is something that happens to us. The rights and the rights that we acquire by being long an option, that gives us control. That's something that, we can invoke, or a right that we can invoke to the seller. So back to our example, we're long 50 calls. We can exercise the 50 calls, and we would if the stock was above $50 at expiration, because there would be value. We'd either exercise the 50 call, which would then change the scenario because we would then take on long stock. And of course, when we take on long stock, there are other obligations. You have to have more money in the account and so forth. So we would either exercise or just sell out the position and take whatever money was, whatever intrinsic value there was in the 50 call. But that's the long side, and that was what we had with the original position, long the 50 calls. If the stock's anywhere between 50 and 60, we have the right to exercise the 50 call and get long the stock, or just sell that call and take in whatever value the 50 call has. On the 60 side, since the 60 is out of the money, according to the question, we have nothing to do. It's going to expire worthless, and we will have taken in whatever credit we sold it for. We're not going to be assigned, because if somebody exercised an out-of-the-money option, they would, be losing money. So that's the answer.
Great, thanks, Joe. We are coming up towards the end of our time today, so I want to
let no, Nick.
know. I know, we could do this all night, Joe, but unfortunately On24 will kick us off if we try to stay here until 10 p.m. But I want to remind all of our listeners that if we weren't able to get to your questions, our investor services desk, which Joe has mentioned a few times, is always available during business hours to take your questions. Call 888-OPTIONS or visit us at optionseducation.org. They're there, help you out, the individual investor. If you have any questions about how a position works, if you want to know about a definition, if you want to run some ideas past them, they're there to help you out. So, Joe, the last question we have today is from one of our more advanced attendees, I would assume, because this listener wanted to know about theta decay. Is it better to buy deep in the money options rather than at the money if you want to manage that theta decay?
Well, certainly. The answer to that is absolutely. But theta decay does not define the risk of the position. Theta is, in the amount that the option value will lose over the course of each day. But, let's go back to the 50-60 call spread. Let's say the stock's at $60. And let's say we got a couple weeks to expiration. So the 50 call is going to have $10 of intrinsic value and, maybe 20 or 30 cents of time premium. So the theta, that option can lose over the next 2 or 3 weeks is only the 20 or 30 cents. But what's the price of that option? Let's say it's $10.20. So it's got a very high delta. On a theta basis, sure, you're not going to lose much, but your potential loss on a delta basis is significant because the value of that option is, $10 and change. If we had the at-the-money 60, sure, if the stock's at 60 and we're long, let's say we're long the 60 call, let's say with 2 weeks to go, it of course depends on how much the stock moves in terms of what the value of that option would be. But, let's say that $60 call is worth $1.50. So there's no intrinsic value. Rather than losing 20 cents over a couple weeks in theta, you could lose $1.50 in theta. So clearly there's far more risk in theta with the 60 call. But, let's go back to one of the basics of options. You can only lose the debit you pay for an option. With the 60 call, sure, there's more theta, but the total value is $1.50. So the max you could lose is $1.50 if you happen to be wrong on the stock and it tanked. You know, that 50 call that we had valued at $10.20, you know, if we were wrong and the stock turned and went to 55, that $10.20 call all of a sudden be worth $5. You'd have lost half your money. So yes, from a theta perspective, there is far more risk in the at the money as you get close to expiration. But the real risk in the position has to do with delta more so than theta. But I like the question, Nick.
Joe, thanks again for your time and expertise today. Any closing questions or thoughts for our attendees today?
No, I just, you know, this is going to be the first in a series. So, as you said before, we've got the survey questions. Please, you know, if you wouldn't mind just taking a second to give us your comments on whether you like this whole idea of the rolling webinars, and we look forward to bringing more to you.
Ladies and gentlemen, thank you so much for attending. We appreciate you being here. We hope you learned something today. While we weren't able to get to all of your questions, as I mentioned earlier, our investor services team is ready to help during business hours. Give them a call at 888-OPTIONS. Reach out to them anytime. Additionally, some of our attendees asked about some position tools that they could use. We have a position simulator available on the OIC website. Just look at the top navigation menu and look under the tools and resources. You can look at different positions. You can model different scenarios, and hopefully that will help you out as well. As Joe mentioned, we're going to be holding our next webinar on Tuesday, July 8th. We'll hit the second part of our discussion on position adjustments. Then our next one is going to be held on July 29th when we'll have Kyle Graham from our investor services team on. He'll be talking about the topic of volatility. Check optionseducation.org or keep an eye on your email in the upcoming weeks. Feel free to sign up for any or all the webinars we've got coming up. As I mentioned earlier, all of these webinars will be archived for later viewing through On24. You can use the same link that you used to attend today to look at the archive session either later tonight or tomorrow. Ladies and gentlemen, thank you so much for attending. We hope you have a great afternoon, and we hope to see you next time.